So the key formula here today is gonna to use the formula to calculate expected return, standard deviation, and CV. Okay, the first concept we want to talk about is risk aversion. It assumes that investors dislike risk, require higher rates of return to encourage them to hold riskier assets. Okay, this is a basic pre-assumption in all of our financial theories and models. Okay, we assume that for any rational investor, we dislike risk. For any financial assets with high risk, we require higher return to compensate us for undertaking the additional risk. Okay, for example, we talked about this before. For example, for treasury bonds, because they're less risky, so we require less return. For corporate bonds, we require higher return because they have higher additional risk. Okay, this is all because that as a rational investor, we are risk averse. Okay, we don't like risk and we have this risk aversion. Okay, and this principle would apply to any financial asset. We also have this risk-return trade-off theory. Higher risk is associated with greater probability of higher return, and lower risk is with a greater probability of smaller return. This trade-off, which an investor faces between risk and return while considering investment decisions, is called the risk-return trade-off. Okay, higher risk, higher return. Lower risk, lower return. Hence, risk requires a return. For example, in panel A, this is from an individual investor's perspective. If we have different investment targets, for investments with higher risk, we would require higher returns. So you see that our risk return trade-off line is upward sloping. At point A, for example, this is something on the line, point on the line, meaning at this level of risk, we would require at least this much of risk. So if we look at up point E, it's going to be a good investment because the return is sufficient to compensate for the perceived risk. Any point above the line would be a good investment because the return is higher than our minimum required return for investments with the same risk. But if we look at point C or any points below the line, it's a bad investment because the return is lower than the minimum required return for the same level of risky assets. The slope of the risk return line depends on the individual investor's willingness to take on risk. A steeper line indicates that investor is more risk averse. So when someone is more risk averse, the line becomes steeper, and for the same level of risk, the person requires a higher return because the person needs more compensation for undertaking the same level of risk. From a company's perspective, when the company is raising money to invest in risky projects, for the certain, we have this cost of capital line for projects with a certain level of risk. For example, point A, we need the project to have at least this much return. Okay, because this is gonna be our cost of capital to raise money to support projects of such risk. So we at least need this much return to compensate our cost. So any project is a good investment if the point is above the line, meaning the return exceeds the cost of capital. Any points below the line is a bad investment because the return is lower than the cost of capital, so you are losing money. The slope of the cost of capital line depends on the willingness of the average investor in the market to take on risk. A steeper line indicates that average investor is more risk averse. So for same level risk of projects, they would require higher return for the investor. That's going to be a higher cost for the firm. Risk premium. The difference between the return on a risky asset and a riskless asset is risk premium. It serves as compensation for investors to hold riskier securities. In this chapter, we focus on any financial assets, including stocks or bonds. And for assets, it could also include real assets such as trucks, machines, hotels, apartments. Okay. And in the bond chapter, we already talked about risk premium. Remember, a rate of return for a bond equals real risk-free rate, which is usually R star, the 3-month treasury bill, plus the 4 other additional premiums. And all of these IP, MRP, LP, and DRP, these are called risk premiums. And we have these premiums because of the risk that the bond has. Okay, R star is the risk-free rate for riskless asset. R is the risky asset, is the return for the risky asset, the bond. So the difference between these two is going to be the other risk premiums. We add it to the risk-free rate, so we can calculate the return of the risky asset. Okay, and we're going to apply this type of method to any assets. And here we're going to focus on financial assets. Expected return. If we want to calculate rate of return on an investment, it's going to be the expected ending value minus cost divided by cost. For example, if 1,000 is invested today and we have 1,100 returned after a year, what is rate of return? We could just use the ending value 1100 minus the beginning value 1,000 divided by the cost, or the beginning value 1,000. So here we have 10% as the rate of return for this project. This is a simple question about rate of return. What if we have probability distributions? Then we would calculate expected return from the probability distributions. Probability distributions are a list of all possible outcomes with the probability of each occurrence. It can be shown graphically, and we have assumption that it is normal distribution. Okay, so if we have a list of a lot of different outcomes, and for each outcome we have a probability, that's called probability distribution, and we say it's normal distribution. And the formula for calculate expected return in such case would be that the expected return R hat equals all the rate of returns in each occurrence multiplied by all the probabilities for each occurrence. Okay, so it's going to be R1, P1, the rate of return multiplied by the probability of the first case or first scenario, plus R2 multiplied by P2, the rate of return in the second scenario multiplied by the probability in second scenario, and goes on until we go to the end scenario. Add all these up, we would have expected return. Okay, so it is the weighted average of returns on the different scenarios, while weights are the probability that the scenario happens. For example, if we have 2 companies here, Martin Products and US Waters, and we have 3 scenarios here. The economy, which affects demand, could be strong, normal, or weak. And for each scenario, we have the probability of 0.3, 0.4, and 0.3. All the probabilities add up to 1. And in each scenario, we know the rate of return of each firm. Okay, so we can use the 3 probability multiplied by 3 returns. So we have 3 numbers here, added up, we would have expected return of the 2 firms. Okay, for the first firm, Martin Products, R hat expected return would be the probability in the strong economy, 0.3, multiplied by its return in the strong economy, 80%, plus probability of normal economy, 0.4, multiplied by rate of return in normal economy, 10%, plus 0.3, probability of weak economy, multiplied by negative 60% rate of return in weak economy. Add up these numbers, we get 10%. And we do the same for the second firm. We also get 10% as the expected return, R hat for US Water. Okay, so this is how you calculate expected return. If we show it in the graph, we can see that the expected return is 10%, but the possible returns in strong or bad economy for Martin Products could be higher or lower than US Water. If we have more scenarios, we could draw a normal distribution for each firm. And for Martin products, the returns are more widespread. It's riskier actually because the returns could be very different from the expected return 10%, while US water is less riskier because the returns are much more concentrated around 10%. The extreme values are much closer to 10%. The tighter the probability distribution of expected future returns, the smaller the risk of a given investment, such as for US water. Hence, we use standard deviation to measure the stand-alone risk. So for both of the firms here, we have the same expected return, but we know US water is tighter and has less risk. And we want to use standard deviation to measure the stand-alone risk here for a certain firm or stocks issued by the firm. Okay, so stand-alone risk is a risk associated with a single operating unit of a firm or assets. Stand-alone involves the risk created by a specific division or project. It's also the risk of a financial asset if the investor only holds one asset, as opposed to the risk of a financial asset held in a portfolio. So in the next in the next two classes, I would say, Chapter 13, Class 3, we would learn about beta. We would know a different measure of risk when the asset is held in a portfolio. But here, stand-alone risk is the risk for the asset if we're just holding this single asset. Okay, and we can use either standard deviation or coefficient variation to measure the stand-alone risk. If we use standard deviation and we want to calculate its value for this Martin product, we can use R, the return in each scenario, minus the expected return, 10%, we just calculated, square it, multiply by probability of each scenario. Add all the scenarios up, take square roots, we would get standard deviation. This is the same as the standard deviation formula you would learn in your math class, but we're applying this to the financial assets situation. Okay, so again, we know the probability of the three economies, and we know the returns of this firm in each scenario. We use R, for example, 80% minus 10%. We use return minus the expected return, okay, for each scenario. So we know the deviation of the actual return each scenario minus the expected return. And then we square the deviation, multiply by probability again, add up. So we have the variance, and then we square root it. So we have the standard deviation. Okay, so if I put this in a formula, the standard deviation of Martin products would be 80% the return of Martin products in the good economy minus the expected return, square it, multiply by 0.3, the probability of good economy, plus 10% the return of this firm in normal economy minus expected return, square, multiply by 0.4, probability of normal economy, plus negative 60% return of this firm in bad economy minus 10% expected return. Square it, multiply by 0.3, probability of bad economy. Okay, and then calculate these, add them up, take the square root. I have 54.22% as the standard deviation for this firm. This stands for how volatile the return of this firm is, how the returns are deviating from the expected return, 10%. Okay, another way to solve for this question is to use the data and stat function in our financial calculator. I will show you later on the calculator, but here it shows the steps. Press second data function. We can input all the returns multiplied by 100 as x and probability multiplied by 100 as y. So here, our return for Martin products in three economies is 80%, 10%, and negative 60%. Multiplied by 100, we're going to input x as 80, 10, negative 60. So we're basically removing the percentage sign. For probability, we have 0.3, 0.4, 0.3 for the 3 economy scenarios. And we're going to multiply by 100 and input 30, 40, and 30 as y. And we're going to press second set until we see one variable. And that should show us n as 100. When we make sure that n is 100, we press down button to see x bar as expected return and sigma x as standard deviation, not Sx. So we know the expected return is x bar, 10%. Sigma is 54.22%. Okay, let me show you this on the financial calculator. Okay, so I can press second data, which is number 7. Okay, and then I see x1, it's gonna be 80. The return in the good economy multiplied by 100. Enter. Down button. Y1 should be the probability for such economy. It's gonna be 0.3 multiplied by 100. So I input 30. Enter. Down button. X2, return in a normal economy multiplied by 100. So it's 10. Enter. Down button. Y2 is the probability in the normal economy, 0.4 multiplied by 100, 40. Enter. Down button. X3, negative 60. Enter. Down button. Y3, 30. Enter. Double check, no other inputs. We press second stat. It shows LIN. So we press second set to change it to LN. And then we keep pressing second set until we see one variable. Then we press down button. So we see that n is 100, verified. Okay, you have to make sure n is 100. Otherwise, you need to double check your inputs in data. And then press down button, we see x bar is 10. So we know the expected return is 10%. Down button, Sx, not what we're looking for. So skip it. Down button. Sigma x, we see 54.2218. Add back the percentage sign. That's going to be our standard deviation. Okay, so data and stat function. Input all your data in data and then show expected return and standard deviation in stat. This graph shows us selected realized returns and standard deviations from 1926 to 2012 in United States for different stocks, bonds, and treasury bills. We can see that it follows the higher return, higher risk principle. For small company stocks, it has the highest risk, so it has the highest return and highest standard deviation. For large company stocks, it has the second highest risk and second highest return. And then the return and risk declines as we go to long-term corporate, long-term government, and short-term corporate bonds. Okay, now let's look at another example here of 5 economy conditions instead of 3. We have recession, below average, average, above average, and boom, 5 economic conditions. And now we have 5 investments instead of 2. We have treasury bills, high-tech firms, collectible firms, US rubber, and the market index. Okay, MP is the market index. For each scenario, the probability is 0.1, 0.2, 0.4, 0.2, 0.1. For treasury bill, all the returns are the same for no matter how the economy is doing. All the other returns are volatile when the economy changes. Why is the treasury bill return independent of the economy? Do treasury bills promise a completely risk-free return? Treasury bill will return the promised 5.5% regardless of the economy. it does not provide a completely risk-free rate, as they are still opposed to inflation. Remember, R equals R star plus IP for short-term treasury bills. Although very little unexpected inflation is likely to occur over such a short period of time. So we see all the same returns for different economies. Another question, how do the returns of high-tech and collectibles behave in relation to the market? High-tech moves with the economy and has a positive correlation. It's a typical. Collectible firms is counter-cyclical with the economy and has a negative correlation. This is unusual. So most industries are like high-tech industries. When the market index is not doing well, when the economy is bad, its return is low. We see all the negative numbers here. When the economy is well, market index is going well, economy is well, high-tech has positive, higher returns. Okay, so high-tech or most industries has the same correlation or positive correlation with the market index or economy. It goes up when the market index goes up. However, there are firms like collectible firms, because of special property, it is actually doing well when the economy is bad or when the market is doing bad. Okay, when the market is doing well, the collectible firms is not doing well. So it's counter-cyclical. This is unusual. Only a few industries are like this, special industries. Okay, collectibles are like this because when economy is bad, more people are hiring these collectible firms to collect their debt back. Okay, we can see US Rubber is a typical firm. It moves, it performs better when the economy or the market is better. Okay. Calculate expected return for each investment. Okay, so you could use what we just learned, use these 5 probabilities multiplied by each returns in each scenario and add them up to calculate the expected return. Or you could input the probabilities as y, returns as x in the calculator. So you could see x bar, expected return, and standard deviation of each stock. Okay, so you could calculate expected return by yourself after class. High-tech has the highest expected return and appears to be the best investment alternative. But is it really? Have we failed to account for risk? So not only calculating for expected return, we also need to use either the formula or calculator to calculate standard deviation for each investment. You can, again, do that after you watch this video. Or you can pause the video now to calculate these. You should get the same numbers as here in this graph. Okay, these are it's just that there's a typo here. Okay, this column, the number is bigger, it should be variance. And for this column, the number is smaller and it should be standard deviation. I just made edits to the file. I hope you can understand that this column is changed to variance and this column is changed to standard deviation. Okay, and you can practice again using formula or calculator to solve for expected return, standard deviation for these 5 investments based on the first graph we provided as the conditions. Okay, and if we draw these graphs on the real graph, or these numbers on the real graph, we can see that treasury bill is of the same return, 5.5 in any of the scenarios, so it becomes a vertical line. And then for high-tech, the expected return is the highest, 12.4%, and it is also very widespread. Okay, it's flat. It's not as concentrated as US Rubber, where US Rubber has a lower expected return, 5.8, but it's more concentrated. The possible returns are more concentrated with the expected return, so it's less risky. Okay, so standard error measures total risk or standalone risk. The larger the standard deviation is, the lower the probability that the actual returns will be closer to the expected returns. So large standard deviation, for example, for high tech, it is associated with a wider probability distributions of the returns. So high tech here, it has the highest return. It also has the highest risk. Okay, so it's not necessarily the best investment. Market has a little bit lower expected return compared to high tech, but also lower risk. US rubber, lower return, but higher risk. So it's not as good as market index. Treasury bills, very stable, no risk. Collectibles, low return, high risk. So this is not as good as market index either. Okay. Practice question. We here have another firm, and we know its expected. We know its probability for 4 scenarios and the returns in each scenario. We want to calculate its expected return and standard deviation. Okay, so please try to use the formula to calculate expected return and standard deviation, and also use our calculator. Okay, please pause the video right now. Try to work this question on your own. And if you finish, you can resume the video and we'll discuss the solution. Okay, so if you have finished this question, please resume the video and let's discuss the solutions. So here we show the formula way and also the calculator way. Okay, I think we especially show the calculator way in here in this document. So for X, we're gonna input all the returns multiplied by 100. So it's gonna be 6, 9, 10, 15. For Y, we're gonna input the probabilities multiplied by 100. So it's gonna be 15, 30, 40, 15. And we go to second data, input these X and Y's, and we go to a second stats. Down button, we make sure N is 100, and then X bar should be the expected return. Okay, if we add back this percentage sign, and that's gonna be 9.85%. Sigma X should be the standard deviation, and we should add back the percentage sign, and it's gonna be 2.54%. Okay, so let me show you on the calculator here. I go to second data, X1 is 6, enter, Y1, 15, enter, X2, 9, enter, Y2, 30, enter, X3, 10, enter, Y3, 40, enter, X4, 15, enter, Y15, enter. Okay, no other things. And we need to go to second stat. Okay, second stat. Okay, and keep pressing second set until you see one variable, because I already did it for the last question, so we just see 1V here. Down button, N is 100. Okay, X bar, 9.85, add back the percentage sign. Sigma S, SX, not the one I want. Sigma X, 2.54, add back the percentage sign. Okay, another way to solve for this question is to use all the returns multiplied by the probabilities, so you have the expected return. Okay, so it's gonna be 0.06 multiplied by 0.15. Okay, 0.009. You have to write this number down and then multiply using 9% multiplied by 0.3, using 10% multiplied by 0.4. Using 15% multiplied by 0.15, and then add them up. So you have 9.85%. And for standard deviation, you have to use these 4 returns, each minus the expected return, 9.85%, square it, multiply by each probability, add them up, take the square root, so you could have 2.54%. Okay, that's return and standard deviation. In the next class, we're going to talk about coefficient of variation. That's another better measure of standard along risk because we're going to use standard deviation divided by expected return. So this measure incorporates both return and risk for the asset. Okay, I'll talk about it in the next video.